Welcome to Cortburg Speaks Retirement, an audio podcast about investing in the stock market, financial planning, money management, and retirement planning. Each Wednesday, we help investors at all stages of life learn how to potentially grow and preserve their money from first job through retirement. Now here's your host, Miguel Gonzalez.
Good morning and welcome to the Cortburg Speaks Retirement audio podcast. Big swings in the stock markets can hurt your retirement savings, but they may be ways for you to stay on track to meet your goals. A recent survey from MetLife found that nearly 70% of plan sponsors who offer retirement plans, such as 401ks, were concerned about participants' abilities to weather market volatility. 61% of sponsors were worried about participants who were already retired. Although the stock market has generally climbed higher in the past 2 years, negative returns plagued the market in 2022. If this happens, it is important not to panic and initiate a sell-off, according to Rob Williams, Managing Director of Financial Planning at Charles Schwab. Doing so could result in missing out on investment gains once the market recovers. One thing to think about is a cushion of savings can help avoid panic. In order to avoid a panic sell-off, experts recommend that current retirees have between 3 and 5 years worth of living expenses in cash, cash equivalents, and short-term investments. That lines up with how the stock market behaves. According to Schwab research, from the 1960s to 2021, it has, on average, taken around 3.5 years for a diversified index of stocks to recover after a downturn. Retirees should have what we call a war chest of cash and bonds that would allow them to fund their living expenses for somewhere between 2 and 5 years, says Taylor Schultz, a CFP and founder of Define Financial. I know that's a big range, and it kind of depends on how much risk the client wants to take. Williams recommends retirees set aside a year's worth of expenses in cash or cash equivalents like a money market fund or high-yield savings account for the more immediate needs. Additionally, he recommends having 2 to 4 years worth of expenses in short-term investments like short-term bonds, short-term bond mutual funds, exchange-traded funds, or even a CD ladder. If you're not retired yet, though, you still have time on your side. And according to the MetLife survey, only 40% of sponsors were concerned about participants who were more than 10 years out from retirement. That risk of a sudden drop in the market, if you're really very heavily invested in stocks, is much riskier when you're close to or in the near early years of retirement than it is if you're in your 30s or 40s, says Williams. You could also benefit from a down market because you're putting money into your portfolio and you're buying into the market at lower prices. Something to keep in mind is which assets should you tap first in an emergency, right? It happens. And retirees who do not have a short-term savings may have no other option but to tap their investment accounts. If they do, Williams recommends and favors withdrawing interest and dividend income first. However, Schultz prefers to reinvest dividends whenever possible. He also recommends focusing on building up that cash cushion over time. For example, if you wanted to build up your cash and short-term investments over the course of 18 months, Schultz suggests selling off some of your investments every quarter until you have the amount of cash and short-term savings that you're aiming for. Both Williams and Schultz strongly encourage retirees to periodically rebalance their portfolios based on their financial goals. So if your portfolio becomes overrepresented or underrepresented in one asset class due to market volatility, you may consider buying or selling certain assets to return the portfolio to its target allocation. The market will tell you when to reposition that money, says Williams. So if the stock market has gone up, you might buy more bonds. If the bond market has gone up, you may be tapping some of that to rebalance and go back to the stock market. Make sure to visit our website, www.cortburgretirement.com. Our site is filled with educational videos, ebooks, publications, and financial calculators designed to help you learn more about your finances. As you search our site, send us a note regarding any questions you may have about any particular investment concepts or products, and we will get back to you quickly with a thoughtful answer. This is Miguel Gonzalez, Certified Retirement Counselor and Managing Partner with Cortburg Retirement Advisors, signing off for this week's educational podcast.
The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group LLC, a registered investment advisor. Private Advisor Group LLC and Cortburg Retirement Advisors Inc. are separate entities from LPL Financial. Investing involves risk, including possible loss of principal.